Hey, welcome investors to the 40 Finance channel. You know, the small cap stocks, Russell 2000, they've all been blasted here, probably more than the large caps over the past few months. And while we don't know if the stock market will bounce back anytime soon, we're starting to get to that point where there's a lot of deals to consider depending on your outlook for the future. Now, for today's video, I'm going to look at stocks that are at or below $20. This is the type of screener that if you would have run an under 20 screener, let's just say 6 months ago, the results would have been dramatically different. But now that prices have come down, there's actually several intriguing names, in my opinion, on this list. Now, the price point of $20 doesn't necessarily make a difference in the broader terms of stock valuations, but all of the stocks under $20 that I have for you here today either have an EPS or they're right on the cusp of profitability. And on top of that profitability, they also have projections for growing their profits and or growing their revenues over the next year or two. Now, before we jump into our list today, shout out to our sponsor, Yahoo Finance Plus. If you guys watch the channel, you know I use Yahoo all the time for my stock research, particularly their historical data, which is second to none. You also have their portfolio tracker and stock notifications, as well as the in-depth Argus and Morningstar research reports, which I use all the time. Now, if you're interested in learning more about Yahoo Finance Plus, make sure you use the link in the description. It gives you 40% off your first month, as well as a 14-day, no obligation free trial. Okay, so to build this list of stocks under 20, I did make a screener here in Yahoo Plus. You can see that I've built several of these things over time, and they really come in handy because there's, 100 different ways to look at stocks, and so kind of slicing them up in different pieces, parts, at least for me, makes it easier when I'm looking for new ideas. And also down here, they have pre-populated screeners based on these criteria that they've written out. For today's video, I'm going to use this one I just made. You can see it's called under 21, meaning under $21. And here's the filters that I use. So price, under 21, sectors. These are the sectors that I follow the most closely, so I feel the most comfortable talking about them on a video. So that's why I've chosen just these four here. And then EPS growth, which this is a handy feature. EPS growth, we want it to be positive, right? We want to see the bottom line at least making some progress year over year. Revenue growth, arguably just as important. Plus 5% is what I'm looking here, plus 5% or more. In this case, I stick with stocks that are listed here in the United States. And just to weed out the unprofitable companies, I put a trailing PE of more than 1. Now, obviously, when you do that, you can have super high PEs. You can have companies with 500 PE or something like that. But you'll see as we come down here, and I'm going to sort this by market cap, that we get a nice little preview before we dig into all these stocks. And that's very helpful because you got, 181 results. We're not going to go through this whole list on this video. I'm going to pick stuff out and edit around it. But you can see how easy it is to kind of comb through these. You get the name, 52-week range, trailing 12-month P ratio, and then they give you an eyeball view of the estimated EPS growth and revenue growth going forward. Okay, we're going to kick off this list with PLTK, Playtika Holding Corporation. And Playtika is an Israeli-based app game developer. And you can see on the one-year chart, it's been as high as 28 back when the stock market was running a little bit hotter. But you do have an EPS of 70 cents. P ratio trailing 12 months, just under 26. And that to me is pretty good considering how much app gaming has taken off over the past couple years. When we take a quick look at the Morningstar fair value, 1880, you got a 3-star price, and these prices are in relation to fair value versus price today, right? So price today of Playtika is 1805. Fair value in Morningstar world is 1880. So that's where the 3 stars come in. If this stock was, let's say at $9 or something like that, it would have a 5-star price because Morningstar would say, you're basically not going to get a better opportunity than that. So pretty good fundamentals as of today. Let's take a look at our projections. And we have 9 analysts on this one. The average estimate for when they report is 67 cents. Now, 67 cents makes me wonder just a little bit because we just saw that their trailing 12 months was in the 70-cent range. However, sooner rather than later, we're going to be looking at 2022. And at least right now, we've got an EPS projection of $1.02, which would obviously bring your price to earnings ratio down to the high teens. And then on the revenue side, plus 8.4% growth projected when they report their final quarter, and a possibility for double digits next year heading into plus 10% range. All right, stock number 2, we got PagSeguro. And this is basically a Brazilian fintech play. They're in the process of digitizing the banking and credit card and peer-to-peer payments in Brazil. So for now, it's running a little bit smaller, but the growth prospects on the bright side look very strong. Now, on the 1-year chart, this one's had a lot of momentum in the past, but the air has sort of sailed on that. You had a price of roughly $61 on August 23rd. Now you're in a steep decline to $15.73. Obviously, fintech in general has gotten blasted, whether it's PayPal or Square or Affirm, they're all just getting hit so hard right now. But, Pags has an EPS 72 cents, P ratio in the trailing view of 21. Morningstar gives it a fair value of 33.40. Let's take a look at the projections. They haven't reported either, so you could get 83 cents out of this year, and then potentially the projection for over $1 next year. So anytime you're in that dollar range, it makes P ratio easy to see. So you'd be looking at a forward PE of maybe 16 or below for this one. And revenue-wise, plus 52% for 2021, potentially another 30% for 2022. And I got to say, this one is attractive to me. It's hard for me to tell here in America how this company is doing in Brazil. So there's definitely an element of like a blind dart throw with this one, but it could be one to put on your radar. All right, stock number 3 is Magnite. This is one that I own. And unfortunately for me, if you look at their 1-year chart, I've been in that 30 some odd dollar range. I have averaged down to about $21. This is a stock that is in the ad tech market, and ad tech, of course, has gotten crushed here recently. And what Magnite does is they're basically on the supply side of managing ad inventory. So their largest client is Disney /ESPN /Hulu. So they manage that inventory, they give Disney an upfront guarantee, and then they go try to sell the inventory and make money on the spread. So for Magnite, it's all about continuing to sign big clients like Disney. And the good news for them is they are heavy in the connected TV space. So they don't have as much risk to the Apple iOS tracking update. That was sort of my bullish thesis on them. The stock's lost a lot of air. But trailing 12 months, you got a 5-cent EPS. We'll see that gets a little bit better. 249 on the trailing PE ratio. Morningstar gives it fair value of 28.83. On the growth prospects, 54 cents. We'll find out this week if that holds true, because I believe they have earnings on the 24th. And then looking ahead to next year, add another dime or something to that. On the revenue side, you got plus 90% if they hit this 420 million, and then an opportunity perhaps to grow plus 28% into next year. So Magnite, again, this is one that I own. There's an opportunity to get in this one much later at a significantly cheaper price, and I will probably be adding little bits and pieces of Magnite throughout this year to try to lower my cost basis. All right, stock number 4 is Cricut, and this is a specialty printer company basically used by consumers for arts and crafts. We actually have one of these at our house, and if you can imagine like a specialized printer that can cut out very specific designs, letters, and shapes right out of the middle of a piece of paper. That's how it gets used for crafting, and they have their own little ecosystem in this world with paper products and idea boards and stuff like that. And Cricut really hit the big time during COVID because obviously people were at home more. But what's interesting about this company is it is profitable. You can see 88 cents here on the EPS, P ratio around 20. Let's take a look at the 1-year chart. The high came back in June at $42. Now you're trickling down to 18. Fair value of $28.75 on Morningstar. Let's see how the growth looks. They have not reported yet this year. So you got 81 cents tabbed out for 2021. That could grow to 90 cents in 2022. That would be 36% growth rate for this year if they hit their revenue numbers, and another double digits projected for next year. So Cricut, if you have anyone who's into arts and crafts, things like that, talk to them about it. But it's very interesting play, and you could see that this could be one that certainly could be bought out by a bigger company and or produce a new line of products, right, that goes along with the specialized printer. So we'll see how they do. All right, next up is DFH, Dream Finders Homes, which, as you can imagine, is a homes builder. And you might be surprised to hear that times are really good for home builders right now. So home builders can use inflation to make more margin, right? So not only does the regular price of an existing home go up in an environment like this, but it takes new homes with it. And then in terms of building materials, you know, they charge based on the materials they use, and they always have a markup in there for themselves. So depending on your outlook on the housing market, you got one here with a $1.13 EPS, P ratio under 17. This is a 1-year chart. The high was last May, 32.69. I'm going to assume that that corresponds with the start of home building season, which we're not too far away from. Here, even in February, you could start thinking about that. Morningstar's got fair value of $29.68. And on the analysis, $1.21 is the goal. We'll see if they report that here in fourth quarter to wrap up the fiscal year. Next year could actually almost double their EPS. So that'll do wonders for your PE ratio. And then you've got 69% sales growth projected through the end of 2021. And that actually is projected to grow in 2022 to 88%. All right, stock number 6, ticker symbol WOOF, is Petco Health and Wellness. And if you don't have a pet and you've never been into Petco, it's more than just a pet store. Obviously, it's more like a pet superstore, but a lot of them have veterinarian clinics as well as groomers and other services within the building. So you're not just banking on the cost of dog food to go up in this case. Obviously, retail plays a big part of it, but this is a little bit more of a broader play on pets if you get interested in it. You can see the 1-year chart. It looks like the high was back in November at 25.69, P ratio of 36. EPS of 51 cents. So I'd say, you know, maybe it's still running a little hot for a retail operation. However, if we look at EPS growth, right now it only stands at a couple pennies more for 2021, sort of the same for 2023, but 2022 in terms of revenue, you do have the potential for an 18% increase there, which could lead to, say, opening of more stores, more profitability. Really hard to tell, but I think when you're working in this pet space, there is a lot of opportunity, and this one happens to be under $20 and at least profitable. All right, stock number 7 is more or less a Bitcoin play, Riot Blockchain. This is a cryptocurrency mining operation, which is really just server farms and a lot of technicians going at it and trying to mine cryptocurrency for profit. Now, one of the reasons that I put this on here, not only because they are profitable from an EPS standpoint, but Bitcoin and some of the cryptocurrencies have been down here in February. And if you never really wanted to buy into a standalone crypto, or you don't have 40,000 for your own single Bitcoin, this can be a way to play the market from the outside and still inherit the advantages, because in a mining operation, just like a gold mining operation, when the price of the asset goes up, the miners inherently make more money. So if you want to take a gander on a profitable company tied to Bitcoin that's not named Coinbase, I don't know how the analysts would project a company like this, because it all is going to depend on cryptocurrency rates. But let's just say 38 cents when they report the end of 2021. That was huge growth on revenue, over 1,600%. Next year, they're calling for triple digits. So you're starting small. And with this one, if you see cryptocurrency continuing, maybe even just flat, maybe even plus 20%, something like that, Riot Blockchain could be a really cheap dart throw to play in this environment. All right, stock number 8 is Digi International, DGII. And I think this company is interesting. It's an industrial Internet of Things communications provider. So if you think of industrial components out in the real world, like cell phone towers, solar farms, wind farms, anything that is out in open land that you need to monitor and have it communicate back to an analytics hub or a corporate hub, that's where Digi International comes into play with cellular and wireless communications networks. And it's not just the network, it's all the components that make these things connect and communicate across each other. So I thought it was very interesting to read about them on their website. It might be something that you like too. Here's your 1-year chart. You kind of peaked out at 24.83, 34 cents EPS, 60 on the trailing 12 months PE ratio. It's not exactly the cheapest one we've looked at here today, but I will say a technology stock that is producing an EPS, albeit at a low level with 34 cents, certainly worth investigating to see what the upside is. Looking over at Morningstar, they give it a fair value of $22.66. As far as projections go, we are in the current year. If they hit $1.50, then you've got a forward PE that is coming down very fast from that 60 mark. 2023, you might get to $1.78. And from a revenue standpoint, it's not explosive growth, plus 18, 19% here in 2022 and another double digits next year. So it's not going to be confused for the biggest grower in the tech space, but I'll say double-digit growth, growing the EPS at a significant rate. There definitely could be some value in here with a stock like DGII. All right, last stock on the list is another one that I own, Palantir Technologies. And regardless of what you think about Palantir, let's just say when it was trading at $28 or $30, the fact of the matter is we're down to $11 here. And while it doesn't show a positive EPS on this screen, across the next fiscal years, it will have a positive EPS. And if you're bullish on Palantir like I am, the attraction is the software, government contracts, which are typically long-term, and now, of course, since their last earnings report, the growth of the enterprise or commercial business, it looks like it's on the cusp of exploding. On the Morningstar side, we got our 5-star price. They've got a fair value of 31. Obviously, we're at 11 today. And on the growth side, EPS this fiscal year, this is why I included it in here. It has a positive forecast of 21 cents, maybe 27 cents next year. And on the growth side, they've pretty much come out and said we're going to be plus 30% for the next few years. So this is a company, at least from its public communications, has said, hey, growth is going forward. We'll let you know when it's not going to be plus 30%. So if you're ever kicking the tires on Palantir stock, or perhaps you're even laughing at it when it was trading for $30, it still might make sense to open your eyes and look again here at $11.02. All right, investors, so those are 9 stocks at or below $20. Each one has an EPS or will have one by the end of this fiscal year, and each one has a growth story to it. So even though it's hard to avoid the negative headlines that are going on right now and the fear and the FUD, it still makes sense to add stocks at the bare minimum to your watch list. Get familiar with them in these times of uncertainty. And if you have a couple bucks on the sidelines that you're not afraid to lose, I think there's some good dart throws in this bunch we just reviewed. Big thanks once again to our sponsor, Yahoo Premium Plus. Don't forget to check out that special promotional offer down in the description. You get a chance to try out the platform risk-free for 14 days. Then you get 40% off your first month. It's a very good deal. All right, guys, let me know what you think of the 9 stocks we featured here today. As always, please give the video a like, share with your friends, all the things. We'll see you on the next video.